Before you glance at another chart, before you tap that refresh button one more time, hoping the numbers magically behave, do yourself a favor. Pause. Shut the apps. Give me the next few minutes, because what follows isn't a hot take, a vibe check, or another influencer shouting into the void. This is a breakdown of something that should not be possible in a functioning global market. And yet, here we are. What happened mid-January wasn't a routine fluctuation or a speculative frenzy. It wasn't retail traders discovering silver on social media. And it certainly wasn't a quirky technical breakout that can be explained away with a trend line. What unfolded was a structural failure, a visible crack in the machinery that has priced silver for decades. And for the first time, that crack became too wide to paper over. For years, critics of the paper metals market have argued that the quoted price of silver had drifted far from physical reality. Vault inventories were shrinking. Industrial demand was accelerating. Eastern buyers were paying premiums that made Western prices look increasingly fictional. Many dismissed these warnings as theory, or at best, long-term speculation. Reasonable people nodded politely and moved on. Then, Wednesday, January 14th, 2026, arrived, and theory turned into arithmetic. On one side of the world, silver futures in New York were trading just north of $90 an ounce, printing what looked like a historic high. On the other side of the planet, the Shanghai Futures Exchange was settling physical silver contracts at roughly $14 an ounce. Same metal, same ounce. Two radically different prices existing at the same moment in time. That is not volatility, that is a contradiction. In a healthy global market, such a gap wouldn't survive more than a few minutes. Traders would buy where it's cheap, sell where it's expensive, and pocket the difference. That process, arbitrage, isn't exotic or optional. It's the plumbing of global finance. It's what keeps markets honest and prices aligned. When arbitrage works, no one notices. When it fails, everything breaks. And on January 14th, it failed spectacularly. We weren't talking about a few cents, or even a couple of dollars. We were staring at a double-digit spread per ounce. Imagine gold trading thousands of dollars apart between major exchanges. Imagine oil price 20% higher in one hemisphere than another, with no war, no embargo, no natural disaster to blame. Regulators would panic, headlines would scream, emergency meetings would be called. In silver, it barely made a ripple. Why? Because acknowledging this gap forces an uncomfortable admission. The Western paper price no longer represents the real cost of acquiring physical silver. It's a reference number sustained by leverage, derivatives, and confidence. And confidence, as it turns out, is a fragile thing. The obvious question follows naturally. If there's such a massive profit available, why isn't capital flooding in to close the gap? And why aren't traders buying silver in New York and shipping it east until prices converge? The answer is painfully simple. There's nothing left to buy. Arbitrage requires metal, actual bars, deliverable ounces. And those ounces are no longer sitting around in New York vaults waiting to be mobilized. You can't exploit a price difference if the underlying asset has already walked out the door. The bridge didn't just crack, it collapsed. And once it's gone, the incentive to cross it is meaningless. The evidence for this didn't come from anonymous sources or speculative blogs. It came from official institutions and cold, boring data. Start with the United States Mint. On the same day the price gap exploded, the Mint halted sales of silver products. Not a brief pause, not a check back tomorrow notice, an indefinite suspension. The reason given was an inability to source silver blanks at current prices. Translation: the U.S. government couldn't buy silver at the quoted market price. Let that settle for a moment. The issuer of the world's reserve currency, the entity responsible for minting legal tender silver coins, went shopping and was told, politely but firmly, no. Not because demand was low, not because factories were idle, but because sellers could get a better deal elsewhere, in markets where physical metal still dictates price. That's not a supply chain hiccup, that's a pricing failure. When the replacement cost of metal exceeds the paper quote, the quote becomes irrelevant. The Mint suspension wasn't an operational detail, it was an admission, a confession that the number flashing on Western screens no longer clears the physical market. At the same time, the private side of the system was bleeding metal. Vault reports showed more than 1 million ounces withdrawn from a single major depository in one day. Across the broader exchange network, nearly 2 million ounces disappeared from reported inventories in 24 hours. This wasn't grandma buying a few coins. This was institutional behavior. Sovereign funds, corporations, entities that don't panic, don't chase headlines, and don't move metal without reason. They were taking delivery, removing silver from shared vaults, and transferring it into private storage where it couldn't to be rehypothecated or promised to 5 different counterparties at once. In other words, they were behaving exactly as you'd expect when trust in a system begins to erode, when paper claims start to feel less like ownership and more like IOUs written in disappearing ink. The futures market itself confirmed the shift. Demand for physical delivery surged to levels never before recorded. Thousands of contracts stood for delivery in January alone, representing tens of millions of ounces demanded immediately, not rolled forward, not settled in cash. This is critical. Commodity exchanges are not built to handle mass delivery. They are pricing venues, hedging tools, and liquidity machines, not warehouses for universal redemption. The entire structure assumes that most participants will close their positions financially. When too many ask for metal at the same time, the math stops working. And that's exactly what we witnessed. A rapid escalation in delivery demands year over year, signaling a collective decision by traders to stop trusting the promise of future settlement and start insisting on present reality. This is what loss of confidence looks like in a market that has been running on fractional reserves. It doesn't announce itself with sirens. It shows up quietly in withdrawal reports, halted sales, and delivery notices that pile up faster than inventories can replenish. The irony, of course, is that this outcome wasn't unpredictable. It was inevitable once paper claims outgrew physical supply by a wide enough margin. The only surprise is how abruptly the illusion broke. Silver didn't suddenly become rare. It didn't magically gain new properties. What changed was belief. Belief that a contract is as good as a bar. Belief that cash settlement is equivalent to delivery. Belief that price discovery still happens where it always has. On January 14th, that belief cracked. The market didn't politely rebalance. It split. And now we're left with two prices, two realities, and one unavoidable conclusion. When push comes to shove, the market that actually has the metal decides what it's worth. Everything else is just numbers on a screen. If you want a single metric that captures just how fragile this market has become, forget the headlines and look at January delivery. Those numbers aren't a footnote. They're a siren. They're telling you, loudly and without nuance, that confidence in paper settlement is bleeding out. Not slowly, not politely, rapidly. Now let S step behind the curtain and look at what this actually means for the institutions that built their business models on the old rules, because this is where things get uncomfortable. Imagine the view from inside a major bullion bank. For decades, life has been good. You short silver futures into rallies. You add paper supply whenever price starts behaving a little too enthusiastically. Volatility works in your favor. Premiums get collected. Risk is hedged. The models hum along nicely. Those models rely on a few quiet assumptions. Physical delivery stays niche. Arbitrage keeps New York and Shanghai marching in step. Vaults in the West always have enough metal to handle the rare moment when someone actually asks for bars instead of cash. None of those assumptions were controversial. They were treated like laws of physics. And now, all three have failed at the same time. You're sitting on a massive short position with an average cost somewhere around $70 an ounce. New York just printed 91. Shanghai is paying north of 100 for physical. Your P&L looks like a crime scene. Risk systems are screaming. Counterparty exposure is ballooning. In normal circumstances, this is where you swallow your pride. Buy contracts, close the position, take the loss, and move on. Except this time, that door is locked. Because these shorts aren't just paper trades anymore. The people on the other side of them are standing for delivery. They don't want cash. They don't want a roll. They want metal. Actual bars. And you don't have them. The vaults that were supposed to backstop the system are empty enough to echo. You can't satisfy a physical obligation with another piece of paper. You need real silver. And there is no real silver available at Western prices. The only meaningful supply is sitting in the East. And even if you're willing to pay up, moving it isn't trivial. China's export controls have quietly turned silver into a one-way street. Metal flows in with ease. It does not flow out. The valve has been tightened. The door has been closed. So you're left with three options, none of them pleasant. Option 1, try to source metal in Shanghai and somehow navigate export restrictions, logistics, and timing while prices run away from you. Option 2, admit failure, trigger force majeure, and absorb the legal and reputational fallout of defaulting on contracts that were never supposed to be tested this way. Or option 3, the option that looks humiliating in the moment but survivable in the long run. You flip. You cover your shorts at brutal losses and you go long. You stop resisting the move and start participating in it. You trade ideology for survival. And based on emerging market behavior, that's exactly what's happening. This is the bank capitulation phase. For years, these institutions acted as the ceiling on silver. Every rally met a wall of selling. Every breakout was smothered before it could breathe. Now, those same balance sheets are becoming accelerants. Infinite liquidity is no longer being used to suppress price. It's being deployed to chase it. That shift is seismic. It removes the single largest structural force that kept silver from discovering anything resembling fair value. When banks are short, rallies die young. When banks are long, rallies tend to develop wings. We don't get a press release announcing capitulation, but the evidence is there if you know where to look. Start with Tuesday, January 13th, when the CME raised margin requirements on silver futures by 15%. This is an old and familiar play. Increase margins, squeeze leverage, flush out speculative longs, give shorts some breathing room. In a normal market, it works like clockwork. Weak hands sell, price dips, the rally stalls. The establishment regains control. This time, it barely registered. Yes, there was a brief dip into the mid-80s, and then the market shrugged, absorbed every contract thrown at it, and detonated higher. New York ripped from 85 to 91 in a matter of hours. Shanghai surged even harder. The margin hike failed. Why? Because the buyers weren't fragile retail traders gambling on momentum. They were industrial users who need silver to keep production lines alive. They were sovereign entities accumulating strategic inventory. And they were banks desperately neutralizing exposure and rebuilding positions on the other side of the trade. When demand is driven by necessity instead of speculation, margin hikes lose their teeth. At this point, the picture is clear. Suppression has failed, arbitrage is broken, official institutions have quietly tapped out, vaults are draining. But silver isn't acting alone, and that's where the story gets bigger than a single metal. Look at gold. Silver can be wild. 3% days happen. We expect drama. Gold is different. Gold is the anchor. The boring, slow-moving $15 trillion asset held by every central bank on Earth. Gold doesn't sprint unless something is wrong. And on January 14th, gold sprinted. COMEX gold printed a new all-time high around $4,600 an ounce, up more than $40 in a single session. That is not background noise. A 1% move in gold is the equivalent of the Dow moving 1,500 points in a day. It doesn't happen because of routine data releases or earnings chatter. It happens during systemic stress. Think back. Lehman Brothers, the 2008 financial crisis, the invasion of Ukraine, the collapse of Silicon Valley Bank. That's the company gold keeps when it moves like this. Gold's message is simple. Something is breaking. When gold surges with this kind of urgency, it tells you that intelligent capital is evacuating risk. Central banks, sovereign funds, family offices that don't chase trends and don't need confirmation from social media. They're reducing dollar exposure. They're backing away from bonds. They're moving into the one asset with no counterparty risk. That move validates silver's behavior. This isn't a rogue speculation. It's a coordinated repricing of monetary metals against weakening fiat. Gold does the heavy lifting. Silver drafts behind it. And the math checks out. Silver historically behaves like leveraged gold, with a beta of roughly 2 to 3. Gold moved about 1% at its peak. Silver moved close to 3. That's textbook bull market structure. Clean, rational, boringly consistent. If silver were up 8% while gold slept, alarm bells would be ringing. That would smell like mania, but gold confirmed. That confirmation matters. Now add the overflow effect. And when capital flees into safety, gold is the first destination. Always. But gold is a large, relatively deep market. It can absorb a lot before price reacts violently. Silver cannot. Its market capitalization is a fraction of gold's. What barely nudges gold can send silver into orbit. $1 billion flowing into gold is a rounding error. $1 billion flowing into silver is a tidal wave. That's what we're watching now. Gold has hit record highs. The safe haven trade is fully engaged. The excess capital, the money that can get into gold fast enough or cheaply enough, spills into silver and amplifies the move. And there's another layer here that shouldn't be ignored: accessibility. At $4,600 an ounce, gold is out of reach for most people. One coin costs more than many earn in a month. Silver, at 91, is still accessible. A silver coin is under $100. That matters. When gold becomes an institutional asset and a luxury reserve, silver becomes the people's hedge. That substitution demand is only just starting. We're still in the institutional phase. The public hasn't fully woken up yet. You don't hear it at the grocery store. Your Uber driver isn't asking about bullion dealers. Your dentist isn't recommending coins instead of toothpaste. When that happens, when silver becomes dinner table conversation, we'll be in a very different phase of this move. We're not there yet. For now, the signals are coming from delivery data, vault withdrawals, bank behavior, and gold's price action. They're subtle enough to be ignored, until suddenly they aren't. We're not even close to the emotional fever pitch yet, and that's an important point to understand. The market hasn't reached the stage where logic completely gives way to psychology, which tells us something critical. There is still significant upside ahead. To see why, we need to zoom out and look at one of the oldest and most reliable measuring tools in the precious metals world, a metric that has survived empires, wars, and currency resets: the gold to silver ratio. This ratio simply asks a straightforward question: how many ounces of silver does it take to buy 1 ounce of gold? For most of recorded monetary history, the answer was remarkably stable. From ancient Rome through medieval Europe, all the way to early America, the ratio hovered around 15 to 1. 15 ounces of silver equaled 1 ounce of gold. That wasn't superstition or coincidence. It reflected the natural scarcity of the metals as they exist in the Earth's crust, and the way societies valued them as money. Then came the modern paper era, and with it, distortion. As futures markets expanded and leverage multiplied, silver became the pressure valve. Gold was allowed to rise to a point, but silver was routinely capped, leaned on, and suppressed. The ratio ballooned to levels that would have seemed absurd for thousands of years of history. 80 to 1 became normal. 100 to 1 appeared during moments of stress. The relationship became grotesque, not because geology changed, but because pricing mechanics did. Now that distortion is unwinding. With gold trading around $4,640 and silver near $91, the ratio has compressed to roughly 51 to 1. That's a dramatic shift from the extremes near 100, and it signals that silver has begun the long journey back toward historical balance. But let's be clear, 51 is not equilibrium. It's not even close. If the ratio were to revert fully to its historical norm of 15 to 1, and if gold didn't move another dollar from current levels, silver would need to trade near $310 per ounce. That's not hype, that's arithmetic. It's not a prediction, it's a reference point, a reminder of just how distorted the relationship still is. And it explains why sophisticated funds and algorithms continue accumulating silver. They aren't chasing headlines. They're executing ratio compression trades, selling relatively expensive gold and buying deeply undervalued silver, betting on mean reversion that has played out repeatedly over centuries. As long as gold holds above $4,000, silver's structural floor keeps rising with it. Gold is the fortress. Silver is the battering ram. When the fortress moves forward, the ram doesn't stay behind. But ratios and history only tell part of the story. The immediate pressure forcing this repricing is far more visceral. The split between Western paper markets and Eastern physical markets. That gap is no longer theoretical. It's operational. It's creating very real panic in places that don't usually panic, like corporate procurement departments. Imagine running a solar manufacturing facility in Eastern China. Yesterday, your raw silver input cost was manageable. Today, it's jumped double digits in a single session. Tomorrow, you have no idea what price you'll be quoted. That's not a chart problem. That's an existential business problem. You don't sit around waiting for clarity. You pick up the phone and you secure supply immediately. This is where industrial demand becomes the immovable object in this market. Investment demand is flexible. If prices spike, investors can wait, rotate, or take profits. Factories can't. A solar panel doesn't function without silver paste. An EV doesn't roll off the line without silver in its electrical systems. A smartphone doesn't work without silver in its circuitry. If you're producing a $1,000 device and silver represents $50 or even $100 of that cost, you don't shut down production to save a few percentage points. You pay the price. Every time. Losing the entire revenue stream to protect a small slice of margin would be irrational. And that leads to behavior that confuses people who only think in financial market terms. When prices rise sharply, investors hesitate. Industrial buyers do the opposite. They accelerate. Rising prices signal scarcity, and scarcity triggers fear of interruption. The rational response is to buy more now, not less later. We're already seeing it. Reports from industry contacts indicate that solar manufacturers and electronics producers are doubling and tripling their usual order sizes. Just-in-time delivery models are being abandoned in favor of just-in-case stockpiling. Inventory buffers are being built aggressively, not because it's efficient, but because it's necessary. This is how price spikes turn into supply spirals. Higher prices signal shortage. Shortage triggers hoarding. Hoarding removes available supply. Reduced supply drives prices even higher. The loop feeds itself. We saw it with semiconductors. We saw it with lumber. We're watching it unfold now in silver. Economists call this an inventory supercycle, and once it starts, it's extremely difficult to reverse. It doesn't stop until prices reach levels that genuinely destroy demand, or until new supply floods the market and restores confidence. Neither condition is anywhere on the horizon. Silver substitution is limited. Its conductive and reflective properties are difficult to replicate at scale. A new mine supply doesn't respond on demand. It takes years, sometimes decades, to bring new production online. Geology doesn't care about quarterly earnings. So let's tally the situation. We have a broken arbitrage mechanism. We have governments unable to source metal. We have vaults draining. We have banks flipping from suppression to participation. We have gold confirming systemic stress. We have industrial buyers panic stocking. And now the final domino is wobbling. Public awareness. For years, silver crept higher in relative silence, from $20 to $40 to $60 to $90, largely ignored by mainstream financial media. That silence wasn't accidental. Acknowledging a sustained rise in monetary metals is an implicit admission that fiat currencies are losing purchasing power. It's easier to look away. But when silver prints all-time highs in New York and blasts through triple digits in Shanghai, ignoring it becomes impossible. Tickers light up, headlines follow, and headlines trigger the most powerful force in markets, fear of missing out. That pivot is beginning now. When retail finally shows up en masse, they'll encounter a market with almost no inventory. The mint is shut. Large dealers are sold out. Local coin shops have empty cases and long waiting lists. And premiums, the real-world cost of actually acquiring metal, are exploding. In India, the world's largest silver-consuming nation, physical prices have reached roughly $132 per ounce. That's a 45% premium over the New York paper price. Read that again. Nearly half the price is premium. That's not normal. That's a market screaming that the screen price is fiction. This is the final proof. The paper quote and the physical reality are no longer related. You cannot buy real metal anywhere near the futures price. That disconnect creates a liquidity vacuum, massive demand slamming into non-existent supply. When buyers discover that reality, panic intensifies. They bid higher. They accept bigger premiums. They compete for whatever metal remains. From the outside, it looks irrational. From inside, the psychology, it's perfectly logical. People aren't buying silver to flip next week. They're buying it to exit a system they no longer trust. From that perspective, paying $130 for something priced at $91 isn't overpaying. It's choosing certainty over promises. So how does this resolve? Equilibrium returns when Western paper prices rise to meet Eastern physical prices, not the other way around. Shanghai doesn't come down, New York goes up, physical scarcity sets the floor, paper leverage eventually yields. That convergence is already underway. The gap is closing not because demand is weakening in the East, but because price discovery is being dragged upward in the West by the gravity of real metal. This is the great disconnect, the moment when 50 years of price control ran into physical reality. January 14th, 2026 won't be remembered for a headline. It will be remembered as the inflection point, when the paper system lost authority and the physical market took it back.